In this video, I want to show you how to trade support and resistance the right way, the correct way. I've seen many people trade or try to trade supply and demand, support and resistance completely wrong, and they're getting really poor results when they really don't have to. If you learn to trade support and resistance correctly, it's the only trading strategy that you'll ever need to be wildly successful. And I'm going to show you how in this video. It's actually very simple. And after you learn to see it, you will be amazed by just not only how simple it is, but also how effective and how intuitive it becomes when trying to trade support and resistance. So we're not going to talk about how to find support and resistance zones, because at system levels, we're using our own indicator, which automatically finds the supply and demand zones that we trade every day on the chart. You'll see on my chart of Microsoft, this is from last week, we have these two horizontal zones, the blue one and the red one. These were basically created by our indicator itself. These are automatically generated by the indicator ahead of time, well ahead of time. The blue zone was created, both zones were created at the beginning of the week, and Microsoft ended up hitting both of those zones near the end of the week, starting on Wednesday. And basically, the two zones confined price on Wednesday, Thursday, and Friday of last week. So we already know where we want to be trading. Okay, we want to be trading when a stock is hitting one of our zones. Okay, and we have the zones from the indicator itself, which is great. That removes 70% of our job, which would otherwise be trying to actually find those zones. We don't have to do that, but we still need to trade the zones. So how do we do that? So let's have a look. We'll zoom into the charts and see it in action. Now the problem is, first I'll show you the wrong way to do it. So then when I show you the right way to do it, it will make more sense. A lot of traders, they either identify a zone. Let's say that I have identified the zone down here. Again, it's automatically generated by my indicator, but let's say that you didn't have it and you had a zone down here. What a lot of people will try to do is, let's say price is coming down. What a lot of people will try to do is they will try to simply buy it when it comes into the zone. Now this will work sometimes, and it will work great because you will catch the bottom of the move. The problem is, what if price just slices through the zone and never comes back? So you're down here buying as price is falling. We never want to be in a position that we're guessing where price will stop or where will the bottom be. We never want to be in that position. So what do we do instead? Well, instead, I like to wait for some sort of confirmation for price to prove to me that this is in fact the bottom of this micro downtrend here. What I need to see is something like this. I need to see some sort of reaction on the zone itself to prove to me that there are in fact buyers down here, and I should expect higher prices after we hit that zone. So I need to see something like this. You see this back and forth down here? This is what I want to see. So I'm not entering as price is moving down. Instead, I'm entering after it has started moving higher. That's a simple concept to understand, right? Of course, you want to see some sort of reaction on the zone that you're trying to trade. It sounds good in theory, but how do you do it in action? Let's have a look at another example. Let's say price is moving higher. We hit the zone. And then what? What I want to see is an initial move lower, like this. Then I want to see another attempt by the bulls to resume the previous uptrend. So I want to see price moving up. It can move up to the zone again, or it can move below the zone. It doesn't matter. I just want to see some sort of higher movement after we hit the zone. It can just be small, like this one here. And then what I want to see is I want to see sellers regaining control of the price action and move below the prior swing low that was created. So what we have here, if we highlight it, is we have the prior uptrend moving higher, hitting the zone here, and then we have sellers stepping in after we hit the zone, bringing price lower. So this is the first attempt to move higher. Very important because that's your first reaction. That's the first thing you want to see after we hit a zone. And then for the third step, this is step number one, step number two. The third step is we want to see buyers try to regain control of the uptrend. This was the previous uptrend. So we want to see buyers try to regain control. And that looks like a move higher. Now this move higher should not exceed the highs up here. This is the temporary highs. This is the first time that we hit the flip zone, or rather our demand supply zone up here, our resistance zone up here. So the attempt to move higher should not break above these short-term highs. That's because I don't want to see buyers being strong enough to make another high. I want them to try to break the high, but I want them to fail. And my entry point will be if sellers regain control and break below this temporary swing low that was created. So now my entry is here at this point, not here when we first hit the zone, because I don't know at that point if the zone will hold and whether sellers will step in and start pushing prices lower. I don't know that at that point. I only know it after I see all this, after I see sellers stepping in, buyers trying and failing to resume the uptrend, and then sellers coming back in and pushing prices lower. So this is the theory. Let's see how that played out on Microsoft last week. Where was I? Oops, here we were. Because this exact scenario played over and over again on Wednesday, Thursday, and Friday of last week as Microsoft was hitting our zones and reversing. The first time this happened was on Wednesday. I am ignoring this price action down here because you'll see that Microsoft opened right on the zone. I'm not really interested in trading when a stock opens right on the zone. So I will be ignoring this zone until Microsoft is able to move away from it. And it did at 10:33 a.m. on Wednesday. So we hit the zone. That's good. That's what we first want to see. We hit the zone here. And then, as I said before, we want to see sellers stepping in like we did here. So we see sellers stepping in. So that's the first thing we want to see. We want to see a reaction. We want to see the zone holding. The second thing I want to see is I want to see an attempt by the buyers to continue this prior move higher. So the first move higher was this one. And the second move higher is this one. So what's happening here is at first buyers had control. That's why they moved higher. They hit a wall of sellers. The sellers were present. We see it by these three candles here. 1, 2, 3. And then we see buyers attempting to continue the movement higher by these two candles, this one and this one. But they fail. They fail to do that because they did not break above this short-term high. They couldn't do that. They would have been successful if they would break above that high, but they did not do that. They couldn't do that. The sellers were too strong. The zone was too strong to be broken higher. And then the moment of confirmation, the moment when we say, okay, the buyers have failed and the sellers are successful, that moment of confirmation happens when we break below this short-term low. This is the first low that is created after we see sellers pushing prices higher the first time, right after we hit the zone. This is that low here. So the first time we break below that low, that's our confirmation entry to go short, in this case Microsoft, and profit from a move lower. So my entry is right here at the lows. The stop loss, you have two options. You can place your stop loss above the ultimate swing high here. That's a good conservative area to place your stop loss. The second best location, which will give you a tighter risk, is place it just above this short-term high. This attempt by the buyers to move higher, the attempt that failed and confirmed that whole sequence. So if you place it above this short-term high, obviously you have a much tighter stop loss. And then when it comes to take profits, I'm very flexible. I like to take profits as a trade is working in my favor. So I'm very quick to take profits because I think our job as traders is to make money, right? That's your job. So as we get initial move lower, for example, this first spike here, the first spike lower, I will be exiting some of my shares here. For example, here. At the same time, after I get paid a little bit, let's say 20%, doesn't have to be massive, I will then lower my stop loss. So not only am I capturing some profits, I'm also reducing the open risk on my position. And then as we move lower again on the second spike lower, I'm again capturing some profits and removing risk, or rather reducing risk. So in this case, we got paid twice. What happens is we move higher again and we hit the same zone for another entry. And the exact same scenario take place. We have the initial move higher that hits the zone. We have the first piece of evidence that sellers are located there. We have the first attempt by the buyers to continue price higher. This is this swing from here to here. And we see buyers failing because sellers take control of price action and move lower. So my entry would be as we break below this short-term low. So here, this is my entry. Again, the stop loss can go above that ultimate short-term high. For me, that would be way too far. So I would place it just above this, the most recent one, right here. That's plenty of space to give price enough breathing room to see if this trade will be successful. And it was. And again, this was good for, I don't know, this was good actually for a 1 to 4.6 risk to reward ratio. So we're risking, let's say $1,000 to make 4,600 in this case. But of course, I like to get paid as the trade is working. So on the first spike lower, I will be exiting some of my shares. On the third spike lower, on the second, and on the third as well. And each time reducing my risk. Every time, little by little, reducing and eventually removing risk from that trade entirely. So these are two examples on the short side. We also had some very nice ones on the long side. And this happened over and over again here, actually. The first time we had the move lower, evidence that buyers step in here, an attempt by sellers to push prices lower, and then that attempt fails from here to here. So our first entry on this sequence is here. That's our entry. Our stop loss is just below this level, which actually coincides with the low of the zone. Now that trade didn't really go very far because it hit our stop loss a little bit later, but there's still time, there's still enough space for you to take some profits and reduce your stop loss. And if you get stopped out here, which I did, you can re-enter if you get another sequence. And we did. After we hit the zone, we had first sellers stepping in, pushing prices higher. Then we had buyers stepping in, pushing prices higher. Then we had sellers attempting to continue the move lower, and that attempt failed shortly after. So our trade was at the high of this spike here. Let me zoom in, make sure that you can see it. So our entry was actually here on this candle, after that candle, or as soon as the candle broke above this short-term high. This confirmed that not only are there buyers here on this zone, but sellers are not strong enough to break below it. So that was our entry. And that moved actually very nicely. And it hit the upper zone eventually. And the whole sequence started again. See if you can spot it here. You can pause the video and see if you can spot that. Where would your entry be in this sequence? Where would the safer entry be? So it would actually be like this. We have the first move higher, the one that hit the zone, the first move lower by the sellers. Then we want to see evidence that buyers are attempting to move higher. And we want to see evidence that buyers fail at moving higher. And that happens when we get this spike lower. So when we break below this temporary swing low here, when we break below this one, right here, that completes the sequence of first we hit the zone, then we see a reaction, we see an attempt by the opposite party to continue in the previous direction, and then we see that attempt failing for us to take the trade lower. You can think of it as first leg is the leg that hits the zone, second leg is the reaction from the zone, the third leg is the attempt by the opposing party, in this case the buyers, to continue in the direction of the first leg. If this fails, we get our fourth leg, and our entry is actually on the fourth leg. So 1, 2, 3, 4. Your entry is at 4. If you don't have this entire sequence, you simply don't take the trade. It's actually very simple, very straightforward. So this is the safest, highest probability way to take to trade supply and demand strategies. In this example, I use our FlipZones. These are these high probability supply and demand zones that are automatically added to our chart every week and every day, provided by the FlipZones indicator, available on our website. But you can use it with any other support and resistance method. So if you're analyzing your own charts and you're finding your own support and resistance levels, you can use the exact same strategy to trade those. I just like to trade with our FlipZones because they are the highest probability supply and demand zones that we have found to be reliable across all markets. So this is basically it. Now you know my favorite way to trade support and resistance. If you have any questions or you have any comments, make sure that you leave them below this video. So thanks for watching and take care.